Welcome to the deep dive. We've been digging through quite a stack of sources on Q3 2025 results for a major platform, really focusing on their strategy around commerce and, well, AI.
That's right.
Our goal today isn't just, reading out the numbers. We want to quickly get to the core story, figure out how they're spending these big profits, and importantly, spot the real, maybe even existential risks tied up in their global growth. The headline number itself is pretty big news. Global revenue strong, up 17% year over year. It actually broke the $1 billion mark.
Yeah, that billion-dollar number, it grabs your attention. But the really fascinating part is where that growth is coming from. It's maybe not where you'd first think. This deep dive shows a company that's gotten really efficient financially, and they're using that cash to make some, well, pretty aggressive bets. High-risk, high-reward stuff.
Okay.
We really need to unpack the regional splits and how the CEO's commentary links that money to future plans, especially AI infrastructure, and shaking up how people shop online.
Okay, let's start with the users then. That seems like the place. They hit a big number, 600 million monthly active users, MAUs. That's up 12% year over year. But looking at the breakdown, it seems like most of that growth is happening outside North America, right?
Oh, absolutely. The user growth story is overwhelmingly international. Rest of world MAUs, that's everywhere outside the US, Canada, and Europe, just exploded, up 16%, hitting 347 million. Europe also saw solid growth, 8%, reaching 150 million users.
Okay, 16% and 8%. And how did the US and Canada compare?
Much slower. Only 4% growth in US and Canada, bringing them to 103 million MAUs. So it's clear their investments in, making the platform relevant locally, personalization, that's really working for user growth in those international markets.
Right, so the user volume is shifting abroad.
Right.
But historically, the value of the money have been concentrated at home. The U.S. and Canada region still pulls in the highest average revenue per user, the ARPU, right? $7.64. So with this massive international user growth, are they actually making decent money off those users yet?
That's the million-dollar question, or maybe billion-dollar question here. And the answer is yes, they are starting to. Though it's important to remember it's from a very low base. So while the US and Canada ARPU only nudged up 5% year over year, which isn't bad,
Yeah, 5% is okay.
the international monetization growth rates are, frankly, staggering. Look at Europe. Revenue up 41% year over year. That's $193 million total. And crucially, the ARPU in Europe jumped 31% to $1.31.
31% ARPU growth in Europe. That's huge for a market that size.
It really is. But hold on, the rest of world numbers are even more dramatic. Revenue there, it shot up 66% year over year, hitting $70 million. And the ARPU in that region climbed 44%.
Oh, 44% ARPU growth. But what's the actual number?
It's still tiny compared to North America. Only the $21, 21 cents per user.
Right, so a fraction of the $7.64 in the U.S. and Canada.
Exactly. But that rate of growth, that 44% increase, shows that international monetization, even from that tiny base, is suddenly becoming the engine driving their overall revenue acceleration. They're actively closing that huge ARPU gap. Seems like it's happening faster now.
And all this growth, combined with efficiency, it's showing up on the bottom line. That's the foundation they need for these big strategic moves, right? We should quickly note the overall financial health. Net income. It soared, up 201% year over year to $92.1 million.
Yeah, 201%. Incredible jump.
And adjusted EBITDA, sort of the core operating profit measure, that grew 24% to over $306 million. Their margin expanded too, up to 29%. Free cash flow also looked good, up 30%.
And that financial performance, especially that net income explosion, that's what gives them room to maneuver, to take risks. All that cash and profit basically buys management the freedom to, well, shift their whole strategy pretty aggressively. They know they can afford the big investments in things like AI.
Which takes us right into that strategic focus. They're spending this money somewhere. Agentic commerce and AI seem to be the big targets. Management isn't just thinking about ads anymore, are they? It sounds like they want to own the whole shopping process.
That's the idea.
Okay, let's unpack that. Agentic commerce. The CEO used that specific term. What does that actually mean for you, the listener? What's the shift here?
Well, agentic commerce really signals moving from just showing you things, from inspiration towards actually helping you buy things. Execution. Historically, this platform was great for finding ideas. You see something cool, you save it.
Right, then you leave and buy it somewhere else, like Amazon or Google.
Exactly. Agentic means the platform itself wants to become your purchasing agent. It aims to cut out the steps, the friction, between seeing something and actually owning it.
Okay, so how are they actually doing that? What tools are they giving retailers to make this work?
They talked about it as part of a bigger expansionary moment happening with search generally. For the big retailers, they're rolling out deeper catalog integrations and also these advanced performance tools, including something called ROAS level bidding.
Okay, hold on. ROAS, return on ad spend. For a lot of people listening, ad metrics might stop at clicks or maybe impressions. Why is bidding at the ROAS level such a big deal for advertisers?
Oh, it's critical because it directly ties the money spent on ads to the actual sales generated. So instead of just saying, hey, retailer, we got you 100 clicks, they're aiming to say, for every dollar you spent with us, we generated X dollars in sales for you. That fundamentally changes the conversation. It positions the platform not just as a place to get visibility, but as a direct driver of revenue.
Makes sense.
Yeah.
And they also mentioned making the buying part easier.
Yeah, enabling things like push-button buying through linked accounts. They mentioned linking directly to Amazon, for example, and said millions of users are already using that kind of feature. It's all about removing those final checkout steps.
I see the strategy forming. Make buying easy with one-click options and prove the value to advertisers with ROAS bidding. And this seems like the perfect entry point for AI to really change the game, moving beyond just finding products to, actively researching them for you.
Precisely. The CEO explicitly mentioned seeing broad-based chatbots as the next evolution of that kind of product research shopping behavior. AI isn't just a feature here. They said it's centralized across the business. It's key for three main things: maximizing monetization, delivering better user results like better recommendations, and really importantly, managing the operational costs of doing all that.
What really stood out to me, and something I think you, the listener, should really clock, is how they're approaching the AI infrastructure itself. It sounds very strategic, almost non-committal. They're not just going all in with one vendor. They talked about constantly assessing things across 3 different layers. Can you walk us through that? Why does that flexible approach matter so much?
Yeah, this is probably one of the most important strategic points. They are deliberately avoiding vendor lock-in with AI, which in a field changing as fast as AI is a really smart way to manage risk. They're constantly testing and benchmarking options across 3 layers.
Okay, what are the layers?
So first, the LLMs themselves, the large language models. They're actively testing different models against each other, which one works best for image tasks, for search, and so on. Second, the chip providers. That's the hardware. They're not just betting everything on, say, NVIDIA. They're looking at options for the actual computing power. And third, the hyperscalers. Think Amazon Web Services, Google Cloud, Azure. They're constantly comparing the cost and performance of running their huge platform on these different cloud services.
So LLMs, chips, and cloud providers, they're playing the field across the whole stack.
Exactly. It's like they're building their own flexible AI supply chain, always looking for the best performance at the best cost, instead of getting stuck with one potentially outdated or overly expensive technology down the line.
That flexibility, yeah, it probably costs more upfront to manage, but it could save them massively long term.
Okay, speaking of costs and value, let's jump back to the UCAN market, US and Canada. Despite having that high $7.64 ARPU, the CEO actually said they're still a long way from having the capabilities of the very largest platforms there. If they already have the most valuable users, where do they see the untapped potential? What are the opportunities they're chasing in North America?
They laid out 3 pretty specific areas where they see more value to capture in UCAN. First, getting deeper access to the full product catalogs of their biggest retail partners. Not just a curated selection, but everything they sell.
Okay, more products mean more potential sales. Makes sense. What else?
Second, really expanding their focus onto the mid-market and the SMBs, small to medium businesses. They noted this segment is driving broader market growth generally, and it's a relatively newer area for them to monetize effectively.
Right, going beyond just the giant retailers. And the third point, it sounded like it tied back to that agentic commerce idea and proving value. Exactly. The third point is all about improving the alignment between their AI bidding systems and the advertisers' own tools, their SaaS platforms. The goal is to provide a crystal clear view of full funnel attribution,
Full funnel attribution.
meaning showing the advertiser the entire customer journey, from the moment a user discovered a product on the platform all the way through to the final purchase. If they can clearly demonstrate that entire path and prove their platform's role at each step, it gives advertisers the confidence, the data they need to justify spending more money. It makes their ad platform feel indispensable.
Okay, so that's the growth strategy. But here's where the narrative takes a turn. This high-growth story runs headlong into some pretty significant risks. We know almost all their revenue depends on advertising, which is inherently cyclical. But the source material highlighted some really big regulatory and AI-specific risks, especially concerning given that their fastest growth is international.
Yeah, that's the crucial context you need to have. The sources paint a picture of a complex and growing regulatory minefield. They specifically mention things like the EU's GDPR, which everyone knows, but also the newer Digital Services Act, the DSA. That DSA imposes hefty new obligations around content moderation, ad transparency, things like that. Plus, there are various new laws popping up aimed specifically at protecting young people on social media.
And complying with all that across different countries must be incredibly complex and expensive.
It is. But the really big one, the one that directly links their international growth spurt to potentially massive global financial risk, is the EU AI Act.
What's the deal with that? What's the timeline? What are the potential consequences?
Well, the EU AI Act is the immediate worry because it actually came into effect back in August 2024. Now, companies do have some time, up to 3 years, to get fully compliant with all its detailed requirements, especially around how they test and document their AI systems, particularly generative AI. But the penalties for not complying, they're explicitly designed to be severe, to really hurt.
How severe are we talking?
Fines can go as high as 7%, not of European revenue, but 7% of a company's total global annual revenue.
7% of global revenue.
Yeah.
For a company that just crossed $1 billion in a quarter.
Exactly. It's a potential multi-hundred million dollar fine based on their current scale. And the risk is amplified because, as we saw, their fastest revenue growth, the 41% in Europe and 66% in the rest of the world, is happening in markets that are or likely will be subject to these kinds of strict AI regulations.
Wow. Okay, 7% of global revenue. That definitely qualifies as an existential risk hanging over the business, and that's just the regulatory side. It's compounded by the risks baked into the AI technology itself, isn't it? Regardless of the laws.
Yes, absolutely. They even acknowledge this directly. They note that using generative AI, the very tech powering their agentic commerce ambitions, can sometimes create content that's, well, wrong, factually inaccurate, flawed, maybe even harmful or against their own policies.
Which opens them up to all sorts of problems.
Right. Brand damage, lawsuits over intellectual property infringement, general legal liability. And the scary part is it's hard to predict all the risks because the tech and the regulations around it are both evolving so incredibly quickly.
And one final operational point we should touch on: their infrastructure dependency.
Yeah.
While they're being smart about diversifying their AI supply chain, the core platform still relies heavily on one provider.
That's right. The source material points out their fundamental operations are still heavily dependent on Amazon Web Services, AWS. And it's not just a casual dependency. They have a massive remaining contractual commitment. It's $584.4 million that they're obligated to spend with AWS through April 2029. So even while they're strategically benchmarking different LLMs and chips, that core cloud dependency on AWS remains a significant factor, both operationally and financially.
Okay, so pulling this all together, what does this mean for you, the listener, trying to understand this company? We've seen this picture of a business doing really well, financially strong profits, rapid international growth in users, and how much money they make per user. But all that success seems to be fueling a major strategic shift. They're trying to become this agentic commerce platform powered by AI.
Yeah, I think that's right. It means they've nailed the short-term operational efficiency game. You see it in the adjusted EBITDA, the huge net income growth. They're running lean and mean. But the immediate future, it looks like a really high-stakes gamble. They're basically betting the house on winning this race in AI and commerce. And they have to do that while carefully navigating this exploding minefield of global regulations, which now carries this very real, very large threat of 7% global revenue fines.
So managing that complexity is key.
Absolutely. How they manage the AI risks, both technological and regulatory, and how they handle their reliance on advertising revenue through whatever comes next economically, that's what will determine if this strong Q3 performance translates into the long-term dominance or if those risks start to crystallize into serious liabilities.
All right, let's leave you with a final provocative thought to chew on. We saw that huge revenue growth coming from Europe and the rest of the world, up 41% and 66% year over year. Given that growth, is the risk of potentially paying a 7% global revenue fine under something like the EU AI Act just becoming a calculated cost of doing business, an inevitable price for operating in those crucial high-growth international markets? Something to think about as you digest these results.